Well, stocks and crypto are down huge. Is real estate next? My good brother, David Serpa is here. What's going on, my man?
Good to see you.
Look forward to this discussion.
Yes.
All right. We've had a lot of long-winded, amazing discussions on this channel.
Oh, sure.
And I'm sure today is going to be one of them because this is a hot topic. We've been talking about this since COVID crash. When it really first started happening, we were kind of like, hey, you know, the economy had lined up for a recession in 2020.
Oh, yeah.
And then COVID happened. And so it was kind of like, okay, well, that for sure has to be something bad, has to take place. And it didn't. It went the opposite way, which is really interesting and surprising to me, in fact, how bullish it was. I was probably the more bullish of the two of us at that time.
By far.
But, you know, I was even surprised by the trajectory. So now that we've had that, you know, 2-year trajectory of kind of up only, we've seen stocks come in. We've seen crypto get crushed. We're seeing flags now of a recession once again, as we had a negative GDP in the first quarter, and it looks like there's going to be a negative in the second quarter.
Yes.
So we'll technically be in a recession next Friday. Is real estate on the chopping block here?
Yes, it is. And this is something that's needed to happen since 2018. And we've been talking about it for a long time. You and I started talking about it in 2020. But what's happened is your average income earner has officially been priced out of their local market. And so when you see prices going up 15% year over year, and you see it happen again and again, you're supposed to see about a 2 to 3% interest in real estate for things to remain consistent. And so finally, after all these years of looking at it and sort of this, you know, this manipulated, prices going up, the stock market going up, and the way that we've been handing out money, and all of a sudden everyone is looking at this market and they're saying, credit card debt is at an all-time high. Interest rates are over 6%, which means that the average person is now spending $600 more on their mortgage than they would have 6 months earlier at the beginning of this year. You've got a year ago, your average person was $400 away from a crisis, but now a year later, your average person's bills are $400 more than they were a year ago. So inflation is out of control. Crypto was an illusion in a lot of ways. The stock market has come crashing right down. And now we're finally at that point where housing prices have peaked. They're softening. And now, in my opinion, because people are always saying, oh, I'm going to sell my house. Well, where are you going to go? It's almost impossible to rent. You know, it's hard to buy. It's harder to rent. We're finally at that situation where in 6 months, 3 to 6 months from now, I think that, you know, people can sell their house, sit on that money, and then be able to buy somewhere in 3 to 6 months and have, you know, saved a little bit.
A better situation. Is that what you're recommending for people right now? You
I'm
think
telling
sell here?
people, unless you need to buy, and there are people who are in that situation, wait 3 to 6 months because what's happened is, just like I said, with interest rates going up the way that they did, your average monthly payment has gone up $600 a month, which means that you need to see prices go down by $100,000 in order to offset that monthly payment. And I think that that's what's ultimately going to end up happening. Your average price in my market is $650,000. The average income being earned is $69,000. The average that you need to, in order to qualify to buy, is $79,000. So you have a lot of people who are renting for significantly less than they would have to buy for. And then if they want to buy, they have to leave the neighborhood that they've been living in for 5, 6, 7, 8 years to go to a neighborhood that's 20 minutes north, 30 minutes north, that they don't necessarily want to live in. And then they're also going to be paying $800 more for their mortgage payment. So a lot of people are finally shrugging their shoulders and saying, no, I'm not willing to do it. And then that's being backed up by the fact that there's less access to cash for a lot of these big spenders. You know, Zillow got hit. You're going to see Open Door take a hit. You know, they overbought for these short-term flips without adding any value into these homes. So I do think, you know, you're going to see a lot of these companies. Zillow already took the hit. Open Door is going to take the hit. You see a lot of companies firing right now.
So you think institutional selling is on the precipice?
Big time, and that's because the cost of you can't short-term flip when the prices aren't going up, and the price to own is about 8 times the annual salary, but the price to rent is even higher. And so the cap rate, the margin for which people are able to make money on a rental, has gone down significantly. So their margins are much smaller. And so the only way to really make money is that long-term hold, because a 30-year market goes like this,
right?
But it does a lot of this in between.
Sure
and right now we're right here. And so it's going to have to go down to correct itself so that people that live in these areas that make a certain amount of money can afford to buy homes in the areas that they live.
have you seen anything yet? Right now we're predicting this, right? But I mean, have you seen, homes selling below comps yet, or things like that? Have you seen a comp bomb or two take place yet?
So there's a couple of different things that you want to look for in moments like this. You want to look at canceled contracts, right? And we're seeing a lot more canceled contracts.
That's true.
You see the amount of offers coming in. There's just less offers. So it's where maybe you had 15 offers, now maybe you have 2 or 3, right? Which still is reasonable. So you cannot price that home $40,000, $50,000 above market value because now no one's going to see it. And so you look at those Zillow saves and you look at the hot homes, and less people are saving homes. Less and less people, because they've just been priced out of the market. Who can afford to buy, that's an FHA, VA buyer, at a 6% interest rate when prices are at an all-time high and we don't have wages that can reflect that?
Yeah. Well, I mean, I've been saying the same thing for the past couple years, honestly. Who are these people who are paying $200,000 above appraised value and waiving it all? Like, where's all this money coming from?
Yeah.
We do know, and the data just came out a couple months ago, we had the highest household net wealth figure in the history of the country. So household net wealth is at its highest point. Now, stocks were higher at that time. Crypto was higher at that time. I don't know if that's factored in or not. So this a little bit ago, so a couple months back, right? But we did hit that point where we had record household wealth. And so I'm sitting here going, well, that's got to be the reason for all of this. The reason why so many people aren't working.
Sure.
And I have people who are telling me, like, I don't know what this person does, but they don't have a job. I'm like, how is that possible?
Well, a big part of that is perceived wealth, right? So, you could say that your home's worth $700,000, but somebody has to be willing to buy it, right? And this next recession that we're going into, we've already seen the blue-collar economy take a hit. That's why blue-collar workers are like, I'm not willing to do that for that. White-collar we're going to see a white-collar recession, and that a lot of the people who are like, what do they do? I never see them working. They got their laptop open, and they're doing all of this. Well, Tesla said, hey, you're probably going to have to come back to work. You have a lot of these companies that are laying off their workforce that are their Zoomers, the people that are Zoom workers, right? And so that's going to have real implications for these local economies because those were the people that were driving up a lot of the market. In addition to the perceived wealth in the stock market, the perceived wealth in crypto, the perceived wealth in NFTs. So the thing is you could say all you want, oh, my house is worth this or this is worth that, but you got to have somebody who's willing to pay it. And right now what you're seeing with a lot of the Bitcoin people is all of a sudden there's this rush to pull money out. And that's when you switch from the bear to the bull, right?
Yeah.
Is when real people say, I've got to get my money out of this. I'm losing everything, right? And they're in a situation where they can't get their money out. And that's when you have, Bitcoin, it's not regulated by anybody. There's no court that you can go to. That's why you see a lot of these scams out there in the world. But everybody in the Bitcoin sinking ship right now, just like everybody who's got all their money in real estate is like, you've got to buy Bitcoin, sell everything that you own to buy Bitcoin, or sell everything that you own to buy real estate. And we can't continue to act like that as an industry and expect that we're still going to have people's respect in these down markets. You can't advise people like a client and then treat your family differently, right?
100%. Is it possible that there's a wealth migration that's also taking place which might usurp common logic? For example, we have people coming here all the time. I talk to them on a regular basis as a loan guy. They're coming from other places.
No, sure.
And they're very, very well off. Doctors, whatever, people who are getting huge jobs, make big salaries and stuff, who are coming here. A lot of people who are self-employed, do really well for themselves, have their own business. They're coming here. Is it possible that some of the people who have been in that neighborhood for 5 to 8 years, that maybe they'll just never be able to afford a home, and that they'll be replaced, by someone who's coming from a different place, who has a different job, or who owns their own business, and that we have an actual migration. We have a flip-flopping going on where wealth is coming to Southern California, and more blue-collar workers are maybe leaving for Arizona, Texas, Utah, et cetera. We know that's going on. The question is to what extent, and is the extent enough that it could buoy a market if, for example, we got some good news, which could be maybe the inflation report comes in better than expected, which would be the first time in a while that's happened. But let's say that happens. And then all of a sudden things change and mortgage bonds become attractive again and rates drop 1%. And and then we could be right back to game on.
It would require a lot of variables to get there, I think. And
for sure.
And I think that a big part of it is, as a society, we neglect our blue collar workers.
No doubt.
We say, hey, listen, if they want to be able to buy a house, they should get a better job. And it's like, okay, so you're acknowledging that job needs to be done, just not that somebody deserves to have a living wage to do it. And so I think that there's a lot of things that have to happen, right? Inventory is going to have to flood the market, which is going to happen anyway. You've got a million new single-family residences that are in the process of being ready to hit the market that haven't done it yet. You've got a million apartments and condos. You've got 650,000 people in a state of serious default in their mortgages. And then you have a 68% in my area year-over-year increase in listings for compared to last year. And so you've got all this market, because the FOMO has now shifted. The FOMO was on the buyer. You better buy a house or you're never going to be able to buy a house. And now you've got that seller who's looking at all that equity, and a 20% hit in equity. It might only take us back a year and a half in pricing, right? But to that seller at 20% in my area, that's $120,000. That's $130,000. $130,000 bucks. It's a lot of money.
Yeah.
And so all of a sudden you're going to see this increased inventory, which needs to happen. Sellers are going to be afraid that they're not going to be able to get everything that they want to get out of their house. Buyers are now going to be placed in a situation where, yeah, prices have come down, but they still can't afford access to the capital to be able to get there. And so, sure, there's that's a possibility that prices will never come down again. But the thing is, even if they came down 20%, they're still not affordable at a 6% interest rate. And I think that what will happen is, in that next year, maybe they come down 20%, because last time prices didn't go like this as fast as they did this time.
True.
This time we saw that 12%, 15% increase in price in year over year. And then so when it goes up like this, it has to correct just as steeply, just as quickly. And so I do think that we'll see that come down pretty significantly. Now, is that going to make housing affordable for our kids, for anyone's kids in the neighborhoods that they grew up in?
That's what I'm worried about.
Essentially, we have entire cities that are gentrifying, right? And this used to be something that just happened in inner city areas, but now it's happening everywhere. But the hope that I see in this is that big capital can't afford to continue to short-term flip, and enough of them tried to do it and lost their ASS, like Zillow did,
yes.
And like Open Door is losing their butts right now. And so they're going to have to flood the market with inventory, or they're going to have to sell off as a portfolio to a Blackstone, a BlackRock, a Progress, and which would be detrimental. But inventory has to hit,
yeah,
in order for to really become accessible again.
Yeah.
So I think we've got 1 year, 20% maybe, 15 to 20% drop in prices, and then I think it will continue to go down for the next 2 to 3 years.
Really? You see a multi-year bear?
I do.
Wow.
I don't think it's going to be like this, like it was in 2008, but I think it will go. It will drop quickly in the next 3 to 6 months, in my opinion, and then it will just kind of continue to go like this because people cannot afford to buy. Big capital can't short-term flip. Pigs get fed and hogs get slaughtered, and everyone went out and became a hog. And then you go and you add that to this being a white-collar recession, propped up by the amount of zombie companies that we have right now in our economy. It's estimated as many as 20 to 40% of companies that are operating in these big fortune are zombie companies. They're operating at a loss. Well, what happens when they start laying off? What happens when people sell off all their stock? What happens when people are rushing to get out of Bitcoin? And the floor is not there right now. Yeah,
it's very, very possible that things could get worse. There's certainly catalysts for that. There's certainly catalysts that things could get better as well. But I don't think in either case, homes become affordable for the median wage earner anytime soon.
And then we describe, well, what's worse and what's better, right? And so in my opinion, prices have to come down in order for it to become better for your average buyer, right? Which means that it's going to be worse for your person that owns 3-4 houses because they've got all this illusion that they have perceived wealth of $300,000 in equity in every house that isn't there because there may not be the person who's willing to spend it. There may not be the person who is capable of getting approved for a mortgage at that price and then being able to afford over the next several months. So I think the first quarter of next year is where the rubber meets the road for me on my thesis, because I believe that there are people who, in the first quarter of this year, when rates, they had been after trying to buy a house for a long time, weren't able to get one because the market was so crazy, and then rates started going up, and that just was the final straw for them. So they signed lease agreements.
And when those people get 9, 10 months into their lease agreement, they have to start thinking about, we're going to buy again, or are we going to, they're going to look and see, is the market better for us to buy now than it was before? Did we make a good decision, or is it worse? And I think in either case, it should be a motivator for them to buy. If they made a mistake by renting and the market's higher, they'll go, well, gosh, we really didn't gain anything here. We threw away a bunch of money. If the market's better, then that should help them go, okay, maybe we should take a look and go look at homes again and get back, because there's a lot of qualified buyers in there.
I agree with you 100%.
That are renting.
100%. Well, what you have is you have a lot of people that are they've been saving money, they've been penny pinching, they've been trying to make it happen, they've been getting bid out by cash. And like we said, cash offers are down 17% from the beginning of the year. They're just not, there's not a lot of big cash that's spending money. And so because they've been tightening it up, because you've got, the feds talking about, they're literally talking about how they've got to tighten inflation. That means that our dollar is going to stretch a little bit less far, but those people that are in that sweet spot where they've got a little bit of money saved up, offers are down. They have a chance. Maybe they could get their closing costs covered. Maybe they could even just get an offer accepted. I feel like there is going to be a little bit of a sweet spot for the people that have been really trying to get in. They're going to make it in by the skin of their teeth. But then I think that about, like you said, 3 to 6 months, rubber meets the road. It becomes a little bit more accessible for some people. But I still think we're going to see it soften from there on out. I feel like it has to. And if it doesn't, it's kind of a depressing thing for our families, for our kids, for the people in the neighborhood that have been renting, that we're waiting to buy, because they just might not ever have that chance again. And I refuse to believe that big money has gotten that big.
I hate to tell you that it has.
Oh, no.
BlackRock. I'm sorry, I don't want to burst your bubble.
Blackstone.
Those guys have long-term plans to own as much real estate as humanly possible, and nothing's going to stop them.
Yeah.
And so if there is an opportunity, if prices really did drop like that,
I
promise you they've got money. They'll scoop up those homes just as fast as they possibly can. In fact, they're still doing it right now through subsidiaries. They're actually talking to a lot of those different portfolio holders. Yeah. They're trying to raise money from guys like me. I've gotten multiple calls. You want to invest in this fund? Here's what we're doing, blah, blah, blah. They're ready, getting ready to buy real estate should the opportunity present
I think that they're going to buy it in portfolios, like what we were just talking about. I think that those companies that are going to go under, like even the small time to mid-time investors that picked up a lot or over-acquired, and now they're losing their butts, are going to be in a situation where Blackstone, BlackRock, because big cash still has cash. Interest rates don't affect them.
Correct.
Right? But the people that were using that cash to then pull capital, the people are going to be less likely to give them cash that they don't have. But that World Economic, that Schwab type money, right? That's not going anywhere, and it is going to be detrimental to our local economies.
Yeah, and I don't think anything can stop that. So I think that's the backstop for the real estate market.
That's a long-term hold.
Yeah.
And long-term hold is always a smart investment, right? But not everybody always has the ability to purchase in long-term holds.
Yeah, hopefully more people will have the opportunity. If you are a potential home buyer, I would say keep your eyes peeled, stay pre-qualified, look at the market, see when an opportunity comes, you want to be able to jump on it. Who knows if the generational opportunity to own real estate will go away at some point. That's my greatest fear. And so I do want to, while I'm bullish always long-term on real estate because the chart looks like this,
correct,
going back as far as you want, sure there might be peaks and valleys. When there's a valley like there is here, if there's buying opportunities, look to take advantage of those.
And make no bones about it, that's where we're at right now. We're like, now you're not competing against 15 other offers.
Right.
Now you might be the only offer. And I've talked
to FHA buyers. I've talked to you.
I listed 3 homes last week. I haven't gotten a single offer. I haven't gotten a single show. And I'm listening to this from a lot of different people. So just like you said, in those little peaks and valleys, and right now we've got a little valley where you might have an opportunity to make your way in. And so if you can afford the monthly, and that's always what I go back to. I never want to drive by a house and see that foreclosure sign out in front. If you can afford the monthly, and you're going to squeak in by the skin of your teeth, that long term is always going to be there, even if you, in the perceived wealth, lost a little bit of money in 3 months, 6 months, 2 years.
Yeah, the only real big risk is, in my opinion, this old saying of, you marry the house, you date the rate, right? You don't have to keep the rate forever.
No, 100%. That's totally fair.
Rates will drop, most likely at some point we get on the other side of this inflation thing, rates will drop. How much will they drop? I don't know. Then you refi.
Yeah.
So you marry the house, you date the rate. That doesn't mean you should go get a house payment you can't afford now with the hopes that you'll be able to afford it later. But just keep that in mind when you're looking at this, when you're looking at rates, that the only way you really get screwed if you buy today and you have a long-term hold prognosis is if rates went higher and stayed higher for a long period of time. That would have a lot of pressure on
And we don't have
prices.
those bad, ugly loans that we have. You're not going to get an ARM.
Right.
Right. And so the thing is, if you lock it in at 6% and then rates drop in the next couple of years by, by two points, holy smokes, you're going to save yourself some money.
Yeah.
You refi. But in the interim, can you make that monthly payment? And if the answer is yes, then freaking jump in.
Yeah.
Because the long term is always good.
That's right. My brother, David Serpa. It's great to see you, man.
I appreciate your time.
Appreciate your time. Hey, share this with your friends. Let's help make them smarter than everyone else. We'll see you soon.